Record-breaking inflation, interest rates doubling within the year, new investors in the stock market are wondering if you always lose money. Rents are increasing everywhere, home values aren't dropping, the car market still feels like it's in a bubble, and there's way too much chatter about the scary R word. Recession. Everyone's purchasing power and discretionary income is diminishing, which is why I thought it would be a good time for everyone to join me around the campfire for a short story about corporate greed. Workers are being punished for inflation. The real culprit is corporate greed by Robert Reich. Big corporations are using inflation as cover to raise prices, yet the U.S. Federal Reserve is raising interest rates, further hurting Americans. One concern I have today is that big corporations will increase prices to match inflation, but actually increase the prices more than inflation dictates. Big oil has hit a gusher. Exxon just reported second quarter profits of $17.9 billion, more than 3 times what it earned a year ago. Chevron's profit more than tripled to $11.6 billion. A corporation's purpose is to drive as much profit as possible. Are they really telling the truth that they need to increase prices because of inflation? Or is it an excuse to make more money? The 2 giant American oil companies aren't pouring their profits back into energy, green or otherwise. They're buying back their shares of stock to reward investors and executives. I think a majority of people would be okay with increasing profits if they knew the corporation was reinvesting the billions in profits in something that would lead to a reduction in prices long term. Chevron has a target of $15 billion in buybacks. Exxon said it was on track with a plan for $30 billion in buybacks in 2022 and 2023. Increase in prices has more to do with fulfilling their desired buyback goals than making ends meet as a business. The 5 oil giants spent more than $20 billion on buybacks in the first half of the year and are likely to spend even more in the second half. Us humans aren't able to grasp the scale of large numbers, so I'll give you a little lesson on how much money $20 billion is. $1 million is a lot of money, right? Someone hands you $1 million in cash and your life is forever changed. Let's change $1 million to 1 million seconds. 1 million seconds is about 11 days and 14 hours. If you had to guess how long 20 billion seconds is, would you guess in months, years, or decades? 20 billion seconds is 634 years, 2 months, and 10 days. That is the difference between millions and billions. President Biden chastised some of the largest oil companies for profiteering off surging energy prices and worsening that pain for consumers as he increased the pressure on them to boost refining capacity and bring down costs at the pump. Now that you have a little bit more of an understanding about the scale of money we're talking about here, you're going to hopefully realize how silly it is that they raise prices because of a relatively little bump in inflation. On Friday, P&G reported another quarter of rising profits despite the increasing costs of raw materials and transportation. How did it manage this feat? By raising its prices even more. P&G announces 4th round of price hikes in 12 months. P&G, Procter & Gamble, the company that seems to own every brand within personal care, health, and hygiene, has had to increase prices on all of their products in order to make payroll and make sure the CEO can pay his rent. In their 2021 annual report filed this year, P&G listed net sales of $80 billion with net earnings of nearly $15 billion. The margins are pretty healthy, but because they're run by shareholders who want to see continued profit, prices are going to pass on to the consumer. As inflation drives up costs, stores and suppliers have to negotiate whether to raise prices for customers. The goal of any corporation is to profit as much as possible, so as long as they aren't engaging in anything illegal or unfairly monopolistic, there's no problem with that. But what I believe we will continue seeing is corporations raising prices to increase profit at a rate greater than inflation. Real wage growth adjusted for inflation declined 0.6% overall in the second quarter and increased only 0.3% year over year. That's inspiring to see, except it doesn't account for the real cost of living expenses, which have been exacerbated by big corporation landlords. An Accountable.us review has found that 10 of the largest publicly traded apartment companies have touted rent hikes, saw their total fiscal year 2021 net income soar by 57% to $5 billion. A net income boost of 57% is indicative of rent hikes in surplus of inflation, with rent being a majority of people's biggest expense. The greed seen in corporate landlords is what's hurting Americans the most. Mid-America apartment communities benefited from strong rent growth and saw fiscal year 2021 net income nearly double to over $550 million after lawsuits for excessive fees and tenant mistreatment in recent years. Meanwhile, its CEO's compensation rose over 60%. I'm a landlord and am all for getting paid adequately, but net income doubling year over year is more of an indication of gouging than an inflation tax. Equity Residential touted its pricing power as it talked about increased rents while reporting that its fiscal year 2021 net income jumped by 45% to almost $1.4 billion while being sued by 135,000 applicants for unlawful conduct in its fee practices. Application fees and random fees from apartment management companies are such a BS money-making scheme. Some will charge everyone a fee to apply and then keep everyone's money even if they don't get the unit. Does anyone recognize this brand? It's time we look at a big company in the auto sector. Carvana was a Rona darling. On March 20th, 2020, the stock's price was $29.35 a share. At its peak on August 13, 2021, the stock was trading at $360.98 a share. This is a company that went from $1.9 billion in sales in 2018 to a trailing 12 months of $14.6 billion in sales in late 2022. That's impressive, right? Well, not exactly. Their operating income indicates that this is a company bleeding money and is destined to fail. When everything shut down during Rona season, an online car dealer was obviously best positioned to take over the car market. This was one reason they experienced surging revenue, but there was another more important factor. Carvana became notorious for overpaying for vehicles. They cared more about increasing revenue numbers on their balance sheet than running a profitable company.
The car dealership Carvana is now facing a class action lawsuit.
Multiple drivers have complained to Action 9 investigator Jason Stujenki about Carvana recently about a range of issues. He's outside of the Charlotte dealership now, where they are facing multiple legal battles.
Their algorithm didn't include a set of instructions to not sell vehicles they didn't have title to.
North Carolina Attorney General Josh Stein told me the Charlotte location is under probation until November, so it's allowed to keep operating, but he says he's keeping a close eye on it.
This isn't indicative of every transaction, of course, but Carvana was selling cars they didn't have title to, which is illegal. North Carolina Attorney General Josh Stein told Stujenki that he's received more than 60 complaints about Carvana that involve all sorts of issues. They're failing to give DMV the title paperwork. They're failing to give inspection reports and the proper paperwork to the buyer and to the lenders who need it in order to do the financing. In a minute, you'll see why they value growth above proper protocols in selling cars. Fox 5 Vegas reports Carvana lawsuit alleges unfair, deceptive practices. I have a car that I legally can't drive. This sounds like a broke fake guru saying that he owns his neighbor's sports car, but he can't legally drive it. It's mine, but I don't have the keys because my dealer is messing me up. The lawsuit claims Carvana failed to timely register cars as it promised, sometimes for a period exceeding 2 years. Some customers are paying their car payment without being able to legally drive their car. This is like putting a bite of steak in front of your dog's mouth and watching him drool. Torture. This is the CEO of Carvana. His father owns a significant amount of shares as well. This tweet from @Ruby_Havenstein includes a chart of all of Ernest Garcia the father's trades during the Carvana stock run-up. He was selling as many as 60,000 shares a day during the month between July 21st and August 23rd. It appears to me that the owners of Carvana pulled every trick in the book to boost revenue, including illegal tactics of selling cars they didn't have title and registration to in order to boost the stock value. As the stock value rose, they sold, essentially dumping their shares on their shareholders, knowing this was a steaming pile of poo waiting to collapse. I don't think it's a coincidence that the father, Ernest Garcia II, waited until the stock tanked to begin buying the stock again. He sold stock every day for about 3 months straight, then quit. I'm not accusing these two of anything illegal, but their behavior doesn't strike me as someone who believes in the company and isn't trying to time the price changes. @Rudy_Havenstein also posted an image showing Ernest Garcia the son routinely going on CNBC to promote his company. Carvana's CEO is the only CEO of the group to frequent CNBC to promote his stock. I don't find that illegal or unethical, but the optics of the entire company aren't favorable in my eyes. Ernest Garcia II. Now it's his time to shine. A brilliant businessman in some sense. In October 1990, Garcia, then a Tucson-based real estate developer, pleaded guilty to a felony bank fraud charge for his role as a straw borrower in the collapse of Charles Keating's Lincoln Savings and Loan Association. In 1991, Garcia bought Ugly Duckling, a bankrupt rent-a-car franchise, for under $1 million and merged it with his own fledgling finance company and turned it into a company selling and financing used cars for subprime buyers with poor credit history. The way that Ernest Garcia, founder of Ugly Duckling, describes it, making money at the low end of the used car business is pretty straightforward. The company buys its average used car for about $3,800. It sells that car for about $7,300. It then charges as much as 29.9% interest on the car loan. The best way to make money in that business is to originate a lot of loans with 29.9% interest attached and sell them off as securities, which is exactly what he did. Ugly Duckling essentially takes batches of used car loans, packages them into pools, and then sells securities. Ugly Duckling became Drive Time. Drive Time was the initial owner of Carvana. Carvana experienced a cash outflow of negative $10.49 per share, or negative $5,800 for each of the 312,000 used vehicle units sold. During one of the most profitable times to be in the car business, Carvana lost nearly $6,000 on every car sold in 2021. Carvana has approximately $3 billion of net long-term debt. To avoid default, Carvana has to pay almost $200 million per year in interest to bondholders. Since they lose money on every car they sell, are facing numerous class action lawsuits, are getting shut down in numerous counties, and aren't making any money, how exactly do they expect to turn a profit? Our last example is a company called Sysco. Sysco says it passed along a 13.4% cost spike to customers with little pushback. Sysco also states that gross profit increased 31.7% to $12.3 billion and gross margin decreased 29 basis points to 18%. Compared in each case to the prior year, the increase in gross profit for the year was primarily driven by higher volumes and high rates of inflation that were effectively managed. I'm not an anti-corporation kind of guy, but I am against certain greedy corporations deliberately gaslighting the American people by blaming price increases on inflation and then making record profits off those increases. Thanks for watching.